Well, I just want to thank everybody for coming. Some people actually sat through the entire day, and I know I have, and I think it's been very informative. A theme is developing, but I will hold my conclusions until we get done with this. I want to thank the panelists for joining us, and the way we have done this is we've just had a casual, open conversation. If anybody in the audience has questions, they'll just submit them in writing. We have a little form, they'll bring it up to me, and I'll try to work their points into the conversation. We have organized folks here in alphabetical order. So Curtis, I think it's alphabetical. Well, no, it's not. But in any event, start over there, and we'll just go right around. Just introduce yourself and what you do and where you work. And once we get everybody to introduce themselves, we'll start.
Well, I have an observation. I think the word got out that Steve and I are Saline County guys, and Jill Dabbs is Saline County gal, and they've all left finding out we were here together. The audience left. But anyway, I'm Curtis Ferguson. I'm from Benton. And I want to thank you, Congressman, for assembling this thing and listening to people. That's kind of unusual for a politician. I don't know what the deal is, but
it's tough.
Maybe you hadn't learned that you're supposed to hi-hat us and just go do what you want to do. But anyway, thanks for showing it.
Thank you.
My name's Steve Good. I'm actually an ex-Saline County guy. I'm a Faulkner County guy now.
We kicked him out.
We got the whole district represented today, for the record.
Right. Mr. Ferguson, he's right. I am from Saline County originally, but own supermarkets in Perryville, Mayflower, Morrilton, and Russellville. A little bit of a cattle farmer. Also on a meat processing facility, and I'm also on our Faulkner County Quorum Court. So, Tim, again, I appreciate you, Congressman, listening to us today. I appreciate all that you've done for us, allowing us to come visit you in Washington early on in your tenure from Faulkner County and visiting with you, and especially your staff. You have an incredible staff that have been very attentive to the calls and concerns that we've had. So thank you very much for doing this today.
Sure.
I'm Sonia Hubbard with Easy Mart in Texarkana, and operate convenience stores. Our first store was founded in 1970 in Nashville, Arkansas, and have a little over 100 stores in Arkansas and 300 within the four-state area. So glad to be here, and hope we get to keep you informed and doing what you do for us.
Thank you.
Ron Hughes, and I'm here representing Pulaski Technical College, where I'm on faculty and work with our green job training. And it's not really part of my job description, but it didn't take long to get into the training to realize that, we have to have jobs for these people when they come out. So I'm particularly interested in energy efficiency and housing. I've worked in that world for 25 years, and so I'm delighted to be invited. So thank you very much.
Thank you.
My name is Matt Jones. I am president of Legacy Capital Group. We have offices here in Little Rock and in Northwest Arkansas. We provide state tax and wealth transfer planning, asset management, and life insurance services, predominantly for entrepreneurs and private business owners. We represent several of the larger private employers in the state. So glad to be here. And I won't tell any stories about Tim and I when we shared an office together in the Friday Law Firm in, I think, the summer of 1993.
I don't remember anything about it.
Wally Lovelace, executive broker for Adkins McNeil Smith and Associates Realtors, and on the board of directors for the Arkansas Realtors Association, chairman of our political action committee, and residential broker in Little Rock.
I think the reason I'm sitting here is the memo came in that he can kick me quicker from here than way over there, so I'll try to behave. Larry Rogers, EM Jeans Express Mail, Conway, Arkansas. It's a retail clothing store in downtown Conway. We've been there for 25 years. Started out with 1,000 square foot and moved to a 10,000 square foot location. So glad you had it. Thank you.
I'm Bill Scholl. I'm president of First Security Bank Corp. We're a $4 billion bank holding company started in Searcy, Arkansas. Rennie Rutledge, we're a family-owned bank, bought the bank in 1977. It was $46 million. Today we have 71 locations around the state, and we also own Cruz and Associates, which is an investment banking firm. Employ about 600 in the bank and about 150 in Cruz, so we feed about 150 families in Arkansas.
I'm Isaac Smith. I'm a principal with Colliers International, commercial real estate and brokerage property management company here in town, the largest property management portfolio. We manage over 11 million square feet, and been in business, founded by Dixon Flake, about 45 years.
I'm Cheryl Wise. I'm Vice President and Treasurer of Dillard's. We have over 300 department stores in 29 states. I'm happy to be here today. Thank you.
Michael Wood, I'm with Liberty Bank of Arkansas. I'm located in Dardanelle. We serve, Liberty Bank serves all the way from Fayetteville, Mount Home, Rogers, Jonesboro, Dardanelle, rest of all the River Valley. My position as a loan officer, lender, I'm in touch with the people every day, and that's who we want to talk about.
I'm John Womack, Chairman CEO of RBS Bank in the Little Rock region. We're a company, about a $13 billion company in 4 states, Arkansas, Oklahoma, Kansas, and Missouri. And we employ over 5,000 people, and we have lots of locations in those 4 areas.
I'm Rodney Shomar. I'm Chief Operating Officer at Arkansas Federal Credit Union. We are the largest member-owned financial cooperative in Arkansas. We have 88,000 members and employ 250 team members, and we serve members in all 50 states and 22 foreign countries.
Thank y'all so much for being here. I just want to start out by talking a little bit about Dodd-Frank and the Dodd-Frank legislation. I hear a lot from constituents about Dodd-Frank, particularly bankers and some in the retail industry as well. I hear both from bigger job creators, small job creators, all across the spectrum. And I would like to hear as much specifics, as many specifics today as possible on what parts of Dodd-Frank are impacting you already, and in what way. And also, I'd be real interested to hear about what is pending, or what are you anticipating that we don't yet have certainty on that will come out of Dodd-Frank that you are most concerned about. I think there's a lot of people. There are a lot of people here who will be impacted by it in some way or another. So, who wants to weigh in and start on that?
Well, I'll be happy to get started, because I don't care much at all for the Dodd-Frank bill. I think it's incredibly, it's going to impact everybody, the consumers mainly. And anytime it impacts the consumers negatively, I think it's a bad bill. But the largest bill we ever had in the banking industry was the Sarbanes-Oxley bill. It was like 143 pages. Dodd-Frank was over 2,000 pages, and it's creating about 10,000 pages worth of regulations. And that doesn't even speak of the credit or the Consumer Financial Protection Bureau. It's just being organized now, who will be regulating a lot of the consumer issues. They have nobody overseeing their decisions. They are part of the federal of the Fed, but they house there, but the Fed has no oversight over them. Dodd-Frank, also had the Durbin issue, and there's several people here who are going to disagree on the Durbin issue about how the revenues were transferred from banking to retail, but ultimately the consumer was the loser on the deal. And I think it's we're going in a real slippery slope when the government price fix and sets prices for the private sector. And I think if we continue to do this, I mean, who's next? Is it the gasoline? Is it what Dillard's can charge for a suit in their department store? I don't know. I just think it's real dangerous.
Okay, and I absolutely know there'll be disagreement on the fee that you're referring to. Other components I'd like to cover first. The aspects that most of you agree on beyond the fee issue, because I know we could spend a long time on the fee issue, which I'm happy to, but but are there areas, any specific areas? For example, I saw an article 2 days ago where an assistant secretary of the Treasury, I think, was speaking, and he said, you know, we hear a lot about Dodd-Frank and its negative impact on small town community banks and access to credit in smaller markets. And he said, that's just not true. And he didn't, I disagree with him completely, but I'd like to hear specifically, what is it about this bill that is putting a burden on, if it is, if you want to tell me it's not, then that's fine too. But what is it about the bill that's impacting you day to day? Obviously, it's there are a lot of new regulations that are being drafted pursuant to it. But any specifically that y'all want to talk about?
Why do you need it? Why was it needed to begin with? You got more regulation than you can interpret. Why was the bill passed?
Well, some people have asked that question and have said, look, we had an issue with the financial markets in September of 2008. We identified Fannie and Freddie as a big part of the issue there, a big part of the problem, but they're not addressed in the bill.
I'll give you a little bit of our perspective on things because as you know, we're a community bank, and I know I've heard you speak before and of your support for the community banks and the wide variance there is with the larger banks and the community banks. But I think one of the biggest issues with Dodd-Frank is the $10 billion limit, as if that is really going to make a difference. As you know, 80% of the deposits in the nation are controlled by about 10 banks. So you've got a high concentration level, yet there are another 7,000 banks that are active and are influenced by this. My big worry about Dodd-Frank is really twofold. One is the unintended consequences that always come out with it. And I'll just give you one quick example of that. Back in 1974, 75, you were probably a little younger then, but I was too. I banked a company in Fort Smith, little cracker cookie production company. At that point, Dick Nixon put in wage and price controls because he was afraid of what was going on with inflation. Commodity prices had risen substantially, a little bit of like what we're seeing today. Their basic commodity, sugar, flour, and those kind of things. Wage and price controls were put on the large companies, not the small companies. So Nabisco, Keebler, the large companies had these price controls. Well, they didn't have the price controls, yet they had to compete against the large companies. So their cost of production for a box of saltine crackers was about 60 cents. Saltine crackers at the time were about 69 cents for a box. Well, the big companies had the benefit of scale, so they could make a little bit of profit, whereas the small company in Fort Smith actually began to lose money because their costs were getting higher. So the unintended consequence became tremendously impactful on a small company. And so that's one of the things. The other thing is the CFPB, the Financial Protection Bureau. As John mentioned, the ability for them to act so independently is the thing that worries us the most. The fact that there's no real controlling oversight that tells them you can't do this and you can't do that, because we fear they will begin to determine products and determine pricing of the things that we can offer to the consumer. And we think that is a bad thing. And I think that you'll find that we understand regulation. We understand FDIC insurance is critical and that our capital basis is going to be significantly lower than a normal business because of that. So regulation is necessary. But all we're asking for is balance and from you courage to deal with the people that are getting these. The one thing that really bothers me with this, I'll quit, I know I'm wandering here, but the letter that senior senator from Illinois, Dick Durbin, wrote to the CEO of Bank of America. I have never seen such vitriol and anti-capitalist rhetoric in anything to any business person in the U.S. I understand the difficulty with the swipe fee. I understand the difficulty of adding additional fees on consumers at this point, and we think the market should take care of that. If Bank of America and Regions want to charge $5 a month for a debit card, we have already begun an advertising program saying we don't do that. We want those customers. We're fine with that. For him to absolutely criticize and go after a specific company, we think is wrong.
Let me ask you this, and please, anybody, speak up on this. If you are, maybe maybe you speak from a retail perspective, or even from even smaller bank than First Security, but the fee aside for a second, what's new about the regulatory structure for you and your bank in Dardanelle? What's new for you as a result of this act? How does this impact credit for folks that live in your area? I have heard, and I think we're already seeing this, but I've heard that a lot of the new compliance costs will be difficult for smaller banks to handle, and they may be gobbled up by bigger banks who can handle it, replaced by a kiosk, whatever. Do you have any thoughts on that?
Well, there's two or three things. One thing we need to get out is the perception of when the media talks about banks, everybody looks to the commercial banks, our community banks, instead of investment banks who have created a lot of these problems. But the way the regulatory issues are affecting these smaller banks, I've seen some small banks quit loaning in-house home loans because they cannot handle all of the issues to deal with it. The high-priced loan mortgage issue, that's what's creating that problem for them. They send it to their secondary market loan officer, and if they can do it, they can do it. But if they can't, I don't know what's happening with their bank. We can handle it in ours, but through this Finance Protection Bureau and Federal Reserve, who created this new good faith estimate and all that kind of issues, it was meant to make things easier for the consumer to read, and to help save cost, but it's created more cost. The appraisals went up, and title insurances went up. And it's made it harder for the lenders to explain the good faith estimate to the consumer, because instead of breaking down the cost, it's lumped a lot of them together. And I bet if you take one of the old good faith estimates out and a new one and showed it to a consumer and asked them if they could understand the cost, they would tell you they could understand the old one a whole lot better.
How are you handling the increased compliance requirements?
We have a central region, northeast region, and northwest, and each region has a compliance officer. And our loan doc processing center, they work with our compliance officers. I mean, and if they go back and review, they select samples of our loans and stuff and review them to make sure we're in compliance. And our central processing center, they watch over our compliance issues for us.
One issue, getting back to the estimated closing costs, the good faith estimate, not only has it gotten more confusing, but it's slowed down the process. Where now, when you give the good faith estimate, if it's off by more than, I think, 5%, and you come down to closing, you've got to prepare a new one, and the buyer has to wait 5 days to close so that he can digest that and review it. We've got a transaction right now where, because of insurance costs and variables that the lender couldn't control, it was 6% off. Well, the house is vacant, the buyer's furniture's on the trailer ready to move in, we can't close because we got to wait that 5 days. Another issue that, of course, isn't decided is the QRM. Whether or not lenders are going to have to keep a 5% reserve on any loans that are over 80%, which would kill the 95% loans for everything but FHA and VA. This just, when I talk to mortgage companies, it's like they say every day I'll get 3 or 4 new pages of regulations and changes, either from HUD or Fannie Mae or Freddie Mac or any number of regulatory agencies, and it's more of what we heard about this morning with the healthcare industry. There's uncertainty, and we have a 2,000-page bill, but we have guidelines, and these non-elected officials are going to be setting the tone, and they don't answer to anybody.
And you are speaking from a real estate.
That's right. Yeah.
From a realtor perspective. So you're telling me you're seeing an impact in your business because you have to deal with the banks to get the money for the loans.
And that ripples out to the retailers and merchandisers. You know, they say under all is the land. Mm-hmm. And in Arkansas, just like the mortgage interest deduction, there's, I think in 2008, the NAR did some research, and there's $500 million in spendable income that is available because of the mortgage interest deduction. Now, I don't think they're going to do away with it completely, but if they start nibbling around the edges, it'll be more uncertainty. If they take away second homes, that hurt Hot Springs or Heber Springs, different parts of the country of our state, and it undercuts the confidence people have in the real estate industry. If they were to take it away, for somebody that had a $300,000 home, you'd lose about $36,000 in equity without a mortgage interest deduction. So it would be catastrophic, and they're not going to do that, but they're going to make people think that they can, and so it's just more uncertainty that this administration is so good at doing.
Cheryl, do you want to share your perspective? Let me ask you this. Certainly address the interchange fee and the Durbin Amendment if you like, but in what ways, in addition to that, separate from that, have y'all in the retail industry been impacted by Dodd-Frank?
Well, from a fee perspective, obviously, as you said, there's going to be a different view at the retail level. I'd just like to point out, first of all, that a debit transaction costs a fraction of a penny to process. So why does it cost so much more, even under the new rule, to go through? But the other thing with regard to consumers is that consumers don't realize that they're paying 2 to 5% or more additional for an item so that they can get their 1% reward on the reward card. So it's a game of inflation. And yes, it's a profit center for the banks and for Visa and MasterCard, but it's also somewhat of it's a duopoly in essence. I have no control. If I don't take Visa and MasterCard, I don't stay in business. They can increase their rates exponentially every year. So, I see this as the first step toward taking the fees on debit and credit back to real level. I mean, it's practically free in Canada. Anyway, so I think it's a good thing for the consumer, and the consumer needs to understand what they're paying for and the inflated price of the products because of their payment choices.
Other than that fee, how is Dodd-Frank impacting?
Well, one area, for
retail?
example, has to do, there are a lot of very specific areas, I guess, I don't really want to go into it, but let's just say, even so on the insurance side, where I think it goes back to the rules are not defined. There's something out there, I think it's going to impact me, but I'm not sure when, how much, or what to do about it. But I've got to make some decisions in the next few months. And so it is very frustrating when you don't know the best business decision to make, because you don't know what the rules are.
And you know something's coming because the law has been passed. But the specificity of the regulations to implement the law are going to take a while, and that's what you're talking about,
Yeah,
right?
and even talking about unintended consequences, there are a lot of times where something is written to take care of a specific issue, and yet unintentionally its scope is expanded, and that's where it creates more problems.
What about the credit union?
Yeah, I mentioned to you earlier, it's in the theme today, and I heard it in the first panel on agriculture, was overregulation. And in our shop, overregulation has really caused us to expand our compliance department. And that's where our job growth has been, but at the detriment of other job growth. We can't, if we have to put our resources into our compliance department, then we can't open new branches, which hires 10 to 12 people, which employs a construction company and all the things that go along with it. We're putting more people in our compliance department. As an industry, we being the largest credit union state, we're still a small industry. We're at about $820 million in asset, which would rank us somewhere about 11th or 12th in size in the state compared to banks. So we're not a large industry. We have about 69 credit unions in the state, none of which have a compliance department. So they're coming to us asking for our input and help, which we're glad to provide, but it's really putting a strain on a lot of the smaller credit unions in the state as well.
So compliance is where, that's where the growth is.
Oh yeah, yes, we've grown the compliance department very nicely.
I want to shift gears a little bit and get the pulse of the folks on the front line, so to speak, retail folks and the realtors, both the commercial and residential. What do you see out there in terms of when you're dealing with consumers, whether it be at your store, whether it be when you're helping people get a house in the commercial market? What are you seeing, particularly in central Arkansas, in terms of, are you seeing a shift? Are you seeing are people still drawing inward? Psychologically, what are you seeing? And also, Matt, with your investors, what are you seeing? And anybody want to speak to that?
Yeah, I'll jump in. Kind of one of the most interesting trends, you hear a lot of negativity, but over the last year, if you just look at, I do a lot of work at retail real estate, which means I represent companies like USA Drug and other retailers on a tenant representation basis going into shopping centers. And if you look at just our Little Rock market alone, we've gone from roughly a 13% vacancy to a 8 or 9% vacancy, which is really telling, I think, of where Little Rock is and how maybe underserved we are with restaurants and retailers. If you look at the finally, I guess, maturing of some of the new retail centers that were maybe built a little earlier at the wrong time, and just the absorption, really overwhelming absorption, I think, as far as absorption of these larger box retail spaces, old circuit cities, things like that in town. That it's a pretty specific example, but where I think, as far as a trend, kind of to answer that question, that's what I see.
And I will say that from what I've seen, I think we have tended to do better than a lot of my colleagues in Congress's districts. Mm-hmm. And a lot of that's just, some of that's numbers, but some of that is anecdotal. I think the diversity of our economy, particularly in central Arkansas with the Fayetteville Shell and all the secondary impacts of the people working and living in those areas and spending that money, I think it is fair to say that we have fared better.
Yeah, I can't say that about all sectors of commercial real estate.
Yeah.
Or certainly you can't speak to the residential side.
I can tell you residential, we've been out of the artificial market where we had the tax credit more than a year now. So July and August, we saw a 20% increase over 2010 in a number of units sold in Arkansas, and the average price dropped slightly, maybe 2% or 3% depending on the market. As I looked at the figures more deeply, I think most of that was attributable to the fact that the big increase in sales was in the lower price range homes under $200,000, which means that those folks are entering the market. The people selling are going to be moving up in the $300,000 and $400,000, and so there'll be a ripple effect there. So our market over the last 3 or 4 years has been one of the strongest in the country, and it's been a battle to try to get those headlines on the front page of the paper instead of in the small print in the business section. Right. But we've been real fortunate. It's not a seller's market for sure. We've got foreclosures that are up, but we've fared well compared to most parts of the country.
Larry, what are you seeing?
Retail sales for us have been up every year, so I really can't. Conway's kind of like a bubble, I guess.
Yeah.
It's always been just phenomenal. And we've got a lot of draw, like everybody thinks Little Rock is the draw, but we have a lot of Little Rock, Maumelle, Russellville people come in, and a lot of people are shopping Conway. So
what's your age demographic?
Our age is going to be anywhere from probably 28 to 48 for the most part.
Interesting. Okay. And in Conway, I don't know the specific figures, but Conway has outperformed a lot of other areas in terms of being able to sustain growth. And I think you've obviously benefited from that.
Right.
got a lot of college folks
Got a
there,
lot of
but that's
college folks.
under
we-
your
Yeah,
demographic,
but
I
then
guess.
again, we moved downtown 5 years ago. We were considered the kid store. But now, anybody here, I know it's hard to believe we could actually fit all you guys and girls, okay? So we've grown up a little bit when we moved downtown. And so we're not doing a lot of the kid traffic like we used to do. But yeah, Conway it's a great place to be right now. And people
Larry's
are
got
spending
great
money.
sunglasses, by the way. These
Larry's got
glasses-
great sun- yeah.
Outstanding. He's right, and Congressman, we are blessed in Faulkner County and Perry County, where I have a store, Conway County in your district where we have a store, and then Polk County. We're blessed because, we've been blessed by the natural gas industry in a big part of the second district, as well as HP in Conway. So we probably haven't seen the effects. I talk to retailers all over the South every day that are in the supermarket industry that don't see double-digit sales increases like we're having in 3 of my 4 stores.
Good.
So we are blessed.
Sonia?
Good. Well, kind of what we're seeing is, to the same point, we have seen steady sales growth, certainly pulled back from what they used to be, but the last 3 years. I think most interestingly, particularly is the fuel, our gallons are still up this year. We're trending up about 4%. We've leveled off for about 2.5. But that is very contrary to the rest of the United States, which is down about, consumption is down about 8%. And I do think we didn't have some of that boom, so maybe we aren't having some of that bust. We're leveling out. One thing that I've noticed both in our business and have talked to other retailers in different businesses, there does seem to be very much a spreading out of, it's like premium products kind of this last year are back on growth. People who have money have kind of shifted and have quit. They're tired of saving and conserving. And then we've seen our discount business in lots of products grow. It's that middle is kind of moving apart. And so I think it shows a little bit. And we have seen an escalation in those using credit. I think we've seen some of those numbers. So,
Ron, I want to ask you, when you are, I've talked to Ron not only in his Pulaski tech capacity, but when I was building my home. And when you are working with folks who want to or are considering making their homes that they're building more environmentally sound so that they can save money, are you finding people are willing to spend the extra now for future savings or not? What are you seeing?
Well, we talked earlier when you first started off today talking about opportunities and barriers. What do we see as trends, opportunities, and barriers? I also have a business that certifies houses for meeting Energy Star, EPA's Energy Star Home Program, energy audits, tax credits for houses 50% better than code and so forth. And that's been my world for a long time. The trend that I've seen, our little company has certified over 300 houses in Arkansas meeting EPA's Energy Star standard. Now that costs that builder extra money. Best building practice, performance testing, it costs them more money, and they did it despite the fact they don't get a higher appraisal because we don't value efficiency in the appraisal. And what I have seen, I think that there is a huge opportunity for jobs, and that's why we're here today, in the residential world, despite us all feeling like in general it's kind of depressed. How in the world could that be? And the reason is the fundamental problem that nobody seems to talk about is that we don't look at the cost of energy when we design the house. We want it to be pretty. When we build it, because we can't get a higher appraisal. When we appraise it, because we don't have comparables. When we sell it, because I was looking through the continuing education classes because we just got continuing education for green and energy for real estate people, and there's no classes offering this kind of stuff. Or most importantly, when we finance it, we look at the cost of energy as principal, taxes, and insurance, and ignore energy, which is larger than typically the taxes and the insurance. There's a bill called SAVE, the SAVE Act that's being introduced. Sensible accounting to value efficiency. And it says, okay, if you've got an efficient house that saves $500 a year or $1,000 compared to the baseline, let's add up principal, interest, taxes, and insurance and deduct that amount. Now that gets that buyer into that house, maybe just a little bit more inclined because it's efficient. They got more disposable income. Then, I love this part, let's take that savings and do a net present value and add it to the appraised value of the house. If that bill passed, I think that's one of the two most important bills in Congress. That one and the PACE legislation for homeowners already live in their house. It'll let you pay off your improvements on part of your property tax. So removes the two barriers. I'm not going to live in the house long enough to get my money back, and where am I going to get my funding? I won't talk about that. We're realtors here today. We're in the lending industry, and that's why I think that SAVE is so critical. If we would do that, if we would just do one thing when you apply for a mortgage loan, what's it going to cost, how much money do you make, and what's the cost of housing, principal, interest, taxes, and insurance, and look at that energy cost. And the first thought is, what if those bills are high? Will it make it hard to sell that house? We've got something called the Energy Improvement Mortgage that next year will be the 20-year anniversary. Dale Bumpers made Arkansas a pilot state for this. You buy an FHA house, I didn't run the numbers this year, but last year, you could borrow from $4,000 to $8,400 for energy improvements, no additional down payment, no second appraisal. You have to show one thing. My savings for those improvements are larger than my mortgage payment increases. I've got a positive cash flow. Think about how many houses that we sell. All houses need something. If we did those energy improvements, what kind of jobs have we just opened up and created? Doesn't cost the government anything. It doesn't cost the seller. Doesn't cost the buyers. All paid for. And I can count on this many fingers how many energy improvement mortgages we've done in 19 years because the buyers don't know. So if we do that one domino, let's look at the cost of energy as a cost of housing, because the way it is, you know, and you know it's true. You're up there qualifying for that loan, PITI. We don't care if your monthly bills for energy are $50 or $500. Makes no difference. Now, do we think that that doesn't impact defaults? We can blame it on the subprime mortgage, loss of job, and divorce. Some of those people could have held on to that house if they could have afforded their mortgage payment and their utility bills. And if they don't do that energy improvement mortgage, especially that first-time home buyer, they get a utility bill for $400. My God, what's the matter? No ceiling insulation, your ducts leak, and your furnace is shot. What's it going to cost? $4,000 or $5,000. Do they have it? No. What's their option? They suck it up and live in this uncomfortable house with high bills until they walk off of them. And then we've been paying people $8,000 to go buy it as part of the stimulus package, and they can't afford to live in it either. Right? So if we would do that one thing, all the dominoes would fall. The appraisers would start to have comparables. We would be able to offer continuing education credits for our lenders, for our appraisals, for right on down the line. And that's what the schools are set up for doing. We're already doing it. We've just had all this RF funds to develop these great training centers, train all these trainers. It's going to be gone in a year. And now, what are we going to do with all those trained people? We could be training a workforce out there, and that's not even counting that other one.
Who drafted the bill? Do you know?
Senator Bennett out of Colorado.
Okay. I'll take a look at that.
Tim, can I make a comment on something I deal with in my business every day? It's a little bit different. We work predominantly with fairly wealthy families, most of which are entrepreneurs and business owners, and many of which are some of the larger employers either in the state of Arkansas or mom and pop operations in smaller communities. And one of the issues that we deal with regularly is business succession and estate tax and wealth transfer planning. And this all goes back to a theme I heard earlier when I was in here this morning, is clarity on regulation and on policy and tax policy. We've watched an exemption go, an estate tax exemption go from $1 million in 2001, I believe, gradually went up to $3.5 million in 2009, went to zero in 2010. We were all telling our clients what we thought it would be in 2011. None of us thought we would have a $5 million exemption and a unified estate and gift tax credit. That completely expires at the end of 2012, and we don't have any idea what the law might be, but if they do nothing, it goes back to $1 million. This has been wonderful news for our larger clients, people with net worths of 50, 100 million plus. They're all giving away their exemptions right now. We're doing some wonderful estate planning. The dilemma is for the mom and pops who bank and do business with a lot of people on this panel that have good businesses that are, let's say they're worth $6 million, $8 million, $12 million. These are still relatively wealthy people, but they're not doing any planning because their attitude is, gosh, estate taxes probably aren't going to apply to me. And so time is passing, and these people are doing nothing, where at the beginning of 2013, if nothing is done, the law reverts back to the 2001 law, which is back to a $1 million exemption. And it's like, could we just get some long-term clarity?
Just pick something.
We're not talking about a capital gains rate, or we're talking about estate taxes that people plan for 10, 20, 30 years out. And so whatever the law is going to be, could we get some clarity?
Well, if we missed our opportunity to die in 2010,
Tell me what your.
I was just going to tell you, you know, we've got it pretty good here as far as general economy. I was talking to some friends of mine out west that have stores in the retail business, and they said that 10 years ago they had Bob Hope, they had Steve Jobs, and they had Johnny Cash. And right now they have no hope, no jobs, and no cash. And now they're praying that Kevin Bacon don't die. So we've got it better than some, but we're looking for things better, and we want you to make it better.
Well, I can tell you that.
And when we get on sales tax, when we get to retailing, I got an epistle I want to share with you on sales tax collections and what's happening in the retail industry. So when you get ready for that, I'm going to lay it on you.
I've been talking to Steve Womack about that quite a bit, you know, and that bill is coming to Judiciary Committee.
Well, I want to meet the guy that sold to Congress on eliminating tax on internet sales in 1990, because that guy could sell aluminum siding to a man with a brick house. I mean, that was rank stupidity on the Congress's part. And you weren't there then, or I would say that.
You don't blame that one on me, my friend. And I'm happy to talk about all that. Let me change gears for a second, if we can. Do you want to talk about your retail posture at Dillard's, how things are going, what y'all are seeing in terms of sales?
You know, I think consistent with what everyone said, I think the consumer is more resilient and perhaps being a little less conservative than they have been in the past. I think to the extent you stock the right product, they're even willing to pay a little bit more for that because that's what they want, maybe buying fewer items but maybe spending as much or more. So it's an interesting time. I think the consumer is a little more resilient than the markets of late.
I have heard a lot about, I hear a lot about credit access. People unable to get loans. I hear that all the time, that people just can't get loans. What's going on with that? Because when I talk to people who are in the business of giving loans, they say, well, we certainly want to give loans because we can make money that way. That's what we do. Do you care to comment on what's going on with that?
Yeah, I don't get the media saying that people can't get loans. I can tell you the consumer right now is not borrowing any money.
It's demand. So you're saying it's demand side.
They're the ones that drive the economy, but they're uncertain about what's going on, whether they have a job. You know, I got to tell you that the commercial customers we have are sitting on the sidelines. They're loaded with cash. There's $2 trillion worth of cash that large commercial businesses have, but the uncertainty of health care, uncertainty of regulations, they're on the sidelines. They're not going to do anything until there's some clarity in leadership in Washington. And I just don't see it changing until that happens. We love to make loans. That's
sure.
How we stay in business.
That's what I thought.
And
we've been making sure I had it right.
Been fortunate in Little Rock. I mean, you know, my region has done real well. Now we've got some regions that are not doing quite as well, but this one is very strong. But
I'll add just a quick comment to that. And one is, I think what John is talking about is our general small business commercial customer. Your main theme that I've heard earlier today is this overregulation. Obviously, our small business customer, their two primary complaints, and I can say this over 40 years of banking, is taxes and regulation. There's always some issue that they're dealing with, something new, something overburdening, that sort of thing. But right now, what we see from the commercial borrowers, the unknowns cause paralysis. So what they do is say, I'm going to wait to see how this sorts out, then I will jump in. I'm not going to expand my business. I'm not going to hire new people. I'm not going to expand my inventory. I'm not going to build a new building, I'm not gonna add equipment until I can see what the future is. I've always said, the smartest guys I've ever dealt with in my life is a small business customer that has to make payroll next Friday. They know what it's like to deal in the everyday world of regulation and taxes and business that we're dealing with. The one thing that Mr. Witt mentioned that I will say though is the mortgage loans that are warehoused in-house, and it gets sort of esoteric, but Arkansas is a little bit different in that we're such a rural state that in many of our small communities, and he may have, I'm sure, see this in Darnell, John may have seen it a little bit in Fort Smith, but in small communities, many of these borrowers do not qualify for the secondary market because there aren't comps on some of the residential properties, or they may be in a rural area or something like that. So the bank will take it in-house and actually warehouse it on their own balance sheet. Well, we now have price controls on that. This high, what do we call it? The high price mortgage. And we get a grid every Friday that we put out to all our lenders in our 70 offices around the state. Here's the maximum that you can charge on this loan that the government has set. There's some people that at 6% might qualify, but at 4.5%, we would say, we're not gonna bank that in-house. So you have now begun to restrict the availability of credit to a group of people that could qualify. So you actually are running into that on these in-house, warehouse mortgage loans.
That's what I was gonna bring up. Also, you know, we're not as fortunate like in Conway and Little Rock. We don't have all the comparables sales around. So like John was talking about, we might have a $200,000 house sitting there that somebody's wanting to buy, but they can't get qualified for this fixed rate of interest, especially right now how as low as it is, and we have to bring it in-house for them to help them. You know, they may have 20% down, but they can't get it financed.
You know, that's one of the unintended consequences of overregulation. We've seen it any number of ways in appraisals. In any situation, or let me say this, over the last 15 years, from 1990, and so they've created a culture where it was riskier to reject a bad borrower than to make the loan, because you get hauled in front of Congress and they accuse you of discriminatory lending. So underwriting just went out the window for years. I had mortgage bankers shake their heads early in this decade saying, I can't figure out how this can sustain itself. But now they've overregulated. They won't let a production office order an appraisal. You have to get somebody from a financial services company or the other side of your organization to order the appraisal. And what happens with some of these is that they'll go out and shop appraisers, and they'll charge the buyer $400 for the appraisal, but the appraiser will say, I'll do it for $200. And now the lender doesn't get that other $200, but the independent financial service company that lines that up, they get the difference. And they bring, in one case, we had an appraiser from Hot Springs came in to appraise a house in Little Rock, didn't know how to get there, and completely blew the deal. I had another transaction where an appraiser in Fayetteville never left Fayetteville, but was $5,000 short on a $650,000 house, and didn't confirm that the house even existed. So, and also they're saying you can't use an appraisal, a comp that's 12 months old. It's got to be 6 months old. And so it's so restrictive, it's just absurd. And so you end up depressing the market because people can't get the price.
And doesn't it have to be within a mile radius?
Well, it depends on the type of loan, but some of them have to be in that subdivision. And if there are 40 houses in that subdivision and 2 sales in the last 10 years.
And if you're in Yale County, Perry County, that's kind of hard to do.
That's right.
Yeah. So what you're telling me is there are people that want a loan, but the rules are, at least at the edges, in some circumstances, they are restricting or prohibiting access to credit.
That's right, and it depresses the value of housing. It hurts the housing market. Ironically, we had a couple buying a house this year He had some student loans that he had defaulted on, so he couldn't be on the note and mortgage, but she had enough income and they were going to buy. We got close to closing, come to find out, he had tax liens in 3 different states. And the mortgage company said, well, we'll just have her buy the house. He won't be on the note or the deed. And we closed it. Now, you know, nobody would have thought that that would have ever closed out. But it delayed it a couple of days. But she had good credit, job stability, good history. And it closed out. So it's easier than what people are led to believe in major metropolitan areas. But out where you don't have comps, it's nearly impossible.
Let me ask you this, and this is, we talked about this a lot in the context of healthcare, for the most part from a different perspective, but we've got a lot of business folks here. What, positive or negative, what has been the impact of the Affordable Care Act on you in your business? Anybody, some of you may fit within the exemption and others not.
Well, the biggest impact really is still the unknown. I mean, we don't know where we're going to be. The second biggest impact is our renewal rate just hit my desk yesterday, and it's up 38% from last year.
38%.
And with the same group of folks, no additional health issues or anything. You know, we own 4 stores, Tim, you know that, and I'm going to tell you that this could be the thing that drives me out of business. This could be what, you know, grocery margins, 1%, 2%. We don't live in a, you know, in a 20, 30% world. We live in a 1 to 2% world, and when you add 30% to your insurance cost, 38%, you know, there goes my profit margin. Mm-hmm. And as much as I love what I'm doing, I can't do it for free.
Yep.
I met with our carrier this last week, and in our company we have about 70 people in total, and we have got she said all of her business, she's a pretty big carrier, had just dropped out. All of the full coverage, just major medical. That's the only thing companies can buy. Catastrophic insurance, in order to be able to pay the premium for our employees, we're probably going to go to just buying for them a catastrophic policy, because the insurance premiums are killer. And ours was up about 30% on the last renewal.
There was someone on one of the earlier panels that said that this could be what drives them out of business.
Well, it's either drives them out of business or you just quit giving the coverage. I mean, no use going out of business over it, just drop it.
Yeah.
I mean, and then everybody's going to go to the University of Arkansas emergency room and let the state pay for it, because I'm not going out of business over it.
Yeah.
Well,
but I am going to.
What are we going to be penalized? I mean, you know, are we going to be penalized under the, you know, and you're going to lose your quality people. You know, I mean, I fight the bigger retailers every day. You know, I can pay competitively with the Walmarts, the Krogers, the Harps of the world. I can pay competitively with them. But if I have to drop insurance, see, I don't have that choice. I can't drop it.
Well, we don't want to drop it, but I'm just saying that the premium is a burden. It's a big burden.
Oh, it's a huge burden.
Sonia?
Well, but the penalty, when you calculate that, because of our turnover rate, getting people in and keeping them long enough and getting them on and off has always been very difficult with insurance. Even when we had full-blown health care, we could not get our employees we had 3,800 employees, and 210 were willing to pay $50 a month to have coverage, full coverage. So it's not seen as the big value, because so many could go to the emergency room. So we had trouble having a negatively selected plan. And so as you look at that and then look at this penalty, not only is it a penalty of, I think, around $2,000 per employee, but it's not tax deductible because it's a penalty. So guess what? You add another 40% on there. And as you just look at that, and as both a CEO of a company whose prime shareholder is my mother, and I look at her and say, the cost to our company, the loss of income, compared to selling out and putting the money in a CD at today's rates, she's probably safer. And that's not where we want to be. We need to promote business. We need to promote employing people.
The first thing you could do is eliminate all this copay business. $10 to go to the doctor. I mean, about 80 or 90% of the people that go to the doctor on that don't need to go anyway. You know, 2 aspirins and good night's sleep. But that's one of the things that raises these premiums is all this deluxe coverage that we're just going to go to catastrophic coverage and hope everybody don't get sick.
There does need to be some education.
There's one other issue too that I've talked to other retailers about, and that is the 30-hour rule, the part-time
Yes.
rule, which I think it's a concern because you don't have to provide coverage below that level. And speaking to turnover and quality employees, people want to work full-time and have full hours, but how do you control your business costs at the same time pay these? And
It's
so I think
conflicting, it's pushing you two different
Well,
ways.
and Cheryl, are you aware that right now they're saying if you had 3 10-hour employees, those
That's
get
a
added
30.
together and are
That's
830.
130.
And so that counts even though, and so, yeah, so there's that concern, there's
And
the
it's very
COBRA
confusing. It's
concern.
an average over a month, over a quarter. What about
Mhm.
seasonal employment?
Yeah.
I mean, there are a lot of
It is,
issues
yeah.
and uncertainty.
Well, somebody
It's
could
the
come.
great unknown.
It is,
I mean,
yeah.
we had a meeting in Memphis with our association and had a lawyer come in out of New York who, Tim, you may know her, but anyway, she came in and spoke to a group of about 300 grocery retailers, and I'm telling you, it was the quarter that we got our year-end patronage rebate. Great jovial atmosphere until she started talking, and she changed the mood like that.
Well, that's
And-
what
and it's
lawyers
just
will
the-
do to you.
Glad we have our
That's a
resident
different
comedian
panel,
here
isn't it?
on the panel.
Hey, Tim, we also in our business, we have really two divisions. We have our wealth management side and our corporate benefits. So we provide consulting services for people for their health and welfare benefits. And so we see that firsthand. And I see, as I talk to my business owners, one of their biggest uncertainties is healthcare. What is amazing to me, if you look at the life insurance side of things, you've got competition across state lines. You've got companies that can discriminate based on how good people take care of themselves. If you go to apply for life insurance, they ask you, do you smoke? They look at your height and weight chart. They look at your family history. They look if you race motorcycles or if you hang glide or if you fly planes. Why is it that everybody in my company or any other company, if they go apply for individual life insurance or, they ask them these questions that allow them to rate what the risk is and price the product accordingly. And then on health care, the person that's 150 pounds overweight and smoking 3 packs of cigarettes a day is paying the same rate as the person who eats healthy, takes very good care of themselves, and is probably going to be much less of a burden on the medical system. My personal opinion, watching the benefits business and having to see our people deliver rate increases to their clients, that they've done everything they can to control them, and they're trying to tell them what a great job they've done, getting them only a 12% rate increase. That until we can impact pricing to where it drives behaviors like we do in other areas of the economy, like you said, if it costs them $85 to go to that, then maybe they take 2 aspirin and they wait a day or two. I think in the healthcare overall, we've got to figure out a way to drive behavior, and ultimately that has a huge long-term impact because, as you know probably better than most of us, the big issue here is Medicaid and Medicare long-term on our budget issues. And we've got to start driving health care costs down today, and in order to do that, we have to impact people's behaviors.
Yep. Let me just tell you, the healthcare, I don't know if any of you were here for the healthcare panel, but a lot of the discussion was about bending the cost curve down, how we are going to grapple with not only healthcare writ large, but Medicare and Medicaid, which are a big chunk of the federal budget and growing. And they are, in fact, look here, in 2050, what we call mandatory spending that's written into law, not appropriated spending that's yearly, but mandatory spending, Medicare, Medicaid, Social Security, will compose the entire budget of the federal government. No Army, no Navy, no Marines, no Air Force, no Department of Labor, no Department of Commerce, HUD, you name it. The entire federal budget will be composed of those benefits right there. And that is why it is not just important to deal with this because it's costing people a lot of money, but it's it's because it's gonna bankrupt our federal government. And what you're seeing here, this ballooning where it gets bigger and bigger and bigger and bigger, that is demographics for the most part. Because what you have, see, it's not as drastic here. You know why it rises so quickly? Baby boomers. That is the baby boom generation moving off of paying in and taking nothing but paying in and moving to the retirement take side. In a system where the average couple pays $100,000 in their lifetime and gets out $330,000. That math doesn't work. And so you've hit the nail on the head, and that's a broader issue.
Well, Tim, if you don't start, maybe this next election cycle, you might have a chance. Otherwise, it's like a fat man going fishing. If he gets his belly over the boat, he's going in. And that's the deal on this socialistic economy, this socialistic Congress that we have. If you don't start means testing people, you just well give up. I mean, it is stupid to give Social Security benefits, Medicare benefits, and all that to people that's got $1 zillion in the bank. I mean, you got to means test it. They earned it. I mean, I think people are ready for it. They'd do it.
Well, I voted to reform Medicare, Medicaid, and Social Security, and haven't quit hearing about it since. And we'll continue to stand by those positions because I'd rather come home.
You should means test everything in government, and then you drug test everybody's getting a benefit, and then you stop it.
Well, you would definitely stop a lot there. But let me just say this.
You drug test everybody that's getting a check. That ought to be the rule. And then to put a lot of people to work, you put a lot of people to work that ain't working now doing the drug testing. They can carry the cups.
But I'm in the Army, so I'm used to that process. Before we move on, I got one more issue, but anybody else want to comment on Affordable Care Act and how it's impacting y'all? I think you get the picture there, unless someone's got a contrarian view. I want to talk about, just real quickly, some regulations, because Sonia's had some experiences with regulations. Hopefully you can recount these wonderful stories for us. And this sort of relates to the environmental side of things. Tell us, if you will, Sonia, the story of trying to do a good thing by replacing your lead, by replacing the refrigerators with the better, more energy efficient refrigerators. Tell us that story, and then if you can tell us the balancing horse story, that's a good one too. These are my favorite regulation stories.
Yes. Well, and this goes back to the ADA compliance laws, which I think no one can contest that. We certainly should help those with disabilities. I think the word reasonable somewhere got left out in this last revision.
Yeah.
And so one of the things that we ran into a problem with and we are struggling with now is we've replaced some of our cooler doors. And with more LEED certified, they don't leak Freon. They much more energy efficient, but they're too heavy to pull because of the weight of the doors is a problem. We have got conflicting information on, I'll quickly, bathrooms. As we remodel a bathroom, I mean, we've actually been trying to escalate some of our construction because this comes in March. And the new rules would require there be 5 feet from the wall wherever the toilet rail sets to the next object. And then you've got to have a sink. Some of you ever been some of the older convenience stores? I would love to have a 5-foot wide bathroom. And they're not 5 feet, and they don't have. So what it's going to cause is that we simply can't remodel. You simply cannot upgrade facilities because if you do, the new compliance regulations come in. And so I think overall that gets into that reasonableness, and it damages and doesn't accommodate your other customers. The pony you mentioned, one of the also obscure acts in it is that we actually have to allow those who use miniature ponies less than 30 inches as balancing aids. They have to come into the store. So you could go into Dillard's and see someone with the little pony. There are no requirements as to what happens if it has an accident. It could be in the banks. And so that's an accommodation we have to do coming in March. So, I mean, some of these things went...
No, wait, I couldn't hear you.
Oh, I'm sorry. It's 30-inch pony used as a balance aid.
These are balancing ponies,
Yes.
and I had never heard of that in my life.
Get in on the ground floor.
Yeah,
You can
so apparently there are...
reading these things.
Yeah, and I had never heard of this in my life, and the common sense part was, to me, is like if someone needed accommodation and they ask you, I'm sure you would
Absolutely.
do whatever you need to do to help this person without needing a federal regulation. What really struck me is you went out, you got these energy efficient freezers for your convenience stores, and because they're so energy efficient, they take a little more energy to open. Well, it is 1 pound or whatever over the limit that the federal government sets. So you were punished basically for getting a more energy efficient freezer. And I asked, has anyone ever not been able to open your freezer? And the answer was no. And certainly if someone couldn't open it, they'd probably, without a federal regulation, turn around and go, hey, I can't get this open, can someone help me? And someone would go help them. I just love those stories because they just show how ludicrous some of this stuff is. We have people being paid salaries in rooms somewhere coming up with this stuff and making sure that you comply with it. I just think that was always an interesting deal. Any other funny stories like that? Well, is there anything that we have not covered that you didn't get to comment on Affordable Care Act? If you'd like to, that's fine. Or if there's anything that anybody wants, you've got something.
Did you read the Wall Street Journal on Friday? Over the last year, there's been 81,405 pages of new rules in the Federal Register, bringing a total cost of the U.S. economy and regulatory compliance to an estimated $1.7 trillion. $1.7 trillion could have been spent creating jobs, getting people back to work.
And that's the last year.
That's asinine.
Yeah, over the last year.
Yeah.
Over the last year.
Congressman, I'd like to tell you, go ahead, excuse me. Oh, I just want to mention, my second.
Go ahead, Ron. It doesn't matter.
I was just going to say, I had to text my wife and make sure the number was right when you ask any other comments on health care. Our 16-year-old had a kidney stone. We took her up to the hospital. They were great, blasted the kidney stone. The total bill was over $20,000. All right. So in terms of when we look at health care, there's that side of it too.
Sure. Oh, absolutely. And that was a big part of the conversation because that drives not only healthcare costs for you, but for Medicare and Medicaid. And a lot of that, in my view, has to do with a lack of market forces. I had one person tell me in healthcare that competition doesn't work in healthcare. Well, we've seen what doesn't work in healthcare. I think it's time for a little competition. Anyway, go ahead.
They were talking about unintended consequences, and you mentioned the Womack bill, which is great if you'll support it, and that's to get the sales tax, get the Main Street fairness in on the sales tax, and we've got a real good example of that today. And Dillard's is sitting here, and they sell on the internet, putting in a big distribution center out there at Mall Mail to supply it, yet they have to charge sales tax in every state they're in while they're getting killed by those who purvey that merchandise. And here's the deal. The unintended consequence is $23 billion in sales tax uncollected across the nation. That's $236 million in Arkansas. Now that would put salve on every sore. And I'm not I'm like a drunk. I don't go to the meetings. I'm not an alcoholic. They go to the meetings. I'm a Tea Party guy. I just ain't a member. I'm taxed enough already, and I'm not purporting to charge more tax, but we're out there beating our head against the wall, selling merchandise, and Amazon.com is opening centers. And I'll tell you how big this is. They opened a center in Tennessee, and they opened a center in South Carolina, and they made them swear that they wouldn't charge tax on Amazon sales in those states, or they wouldn't put in those 1,000 jobs. Well, here's the deal. They want to put the centers in across the states so they can start selling furniture, mattresses, and all the other stuff that they're killing on. But Isaac was talking about space being used here, commercial space being taken up, but across the nation, mall space and shopping center space is down, not only in vacancy, but it's down in all rents. It's been adjusted. Now, here's the unintended consequence. States, and this was on NBC News, this is the extremes caused from a lack of taxes. North Dakota, some of the schools have gone 4 days. Alto, Texas fired their police department. They just let the county take care of it. San Diego sold their horses. They don't have any more mounted police. A town in Florida saved $200,000 by taking the fluoride out of the water. And in Newark, New Jersey, they told all the employees at City Hall to bring their own toilet paper. But they flushed that idea eventually. That's the truth. But they're all strapped for money. Now, Gap just closed 700 stores. In the paper today, Lowe's closed 20. Circuit City closed over 400. Best Buy is on the bubble. They'll be next. And those people that I've mentioned are being directly affected by that great monster Amazon. Yesterday we checked Amazon, 42-inch TV, $278 or $478, freight paid, no sales tax. Walmart, same price, sales tax. Now, the unintended consequence that never gets talked about. Ad valorem tax supplies, we run our schools and somewhat our towns with the ad valorem tax on the brick and mortar. In Saline County, Walmart has $13 million worth of inventory assessed on the books. They have $25 million worth of brick and mortar assessed on the books. They pay in Saline County $450,000 a year to county taxes. And their biggest competitor today, their biggest threat, is Amazon.com, who does not employ anyone, does not pay a penny tax, and they're eating the lunch of the retail merchants on Main Street. Now, Borders just went out. To give you a comparison, Barnes & Nobles in Little Rock with 2 stores, one in Little Rock, one in North Little Rock, their tax bill, $88,000 ad valorem taxes. And that runs the schools. So I'm asking you, I'm imploring you to get on this deal and get this Main Street fairness so that those people that sell merchandise in this county, Pulaski County, Saline County, if they ship it in here, they collect the tax and send it in. Mm-hmm. And then that becomes fair to those of us who have businesses and are collecting the tax, paying county taxes, and employing folks.
Sure. Let me tell you where I stand on that, and we'll close out. I've met with Hank Brown. I've met with a lot of, he's your competitor, I know.
That's good. Yep. He's got brick and mortar. We're even.
Oh, yeah. I mean,
I'll fight it out with anybody that's even.
Well, I know. And the others. But I've met with a bunch of those folks. I met with Steve Womack on it, and I've talked to the Walmart folks. A couple things. First of all, the bill that Womack introduced is different than the Main Street bill in the Senate. The Main Street bill in the Senate mandates or basically says this is the rule, this is what the states are going to do. The bill that Womack introduced gives states the option. There's a lot of people. There are a lot of bills that are introduced in the House and in the Senate. That's what you do. Very few pass. If they don't pass, they're no good to anybody, right? So I'm not in the business of just. I told Womack, I said, look, your bill is going to go to the Judiciary Committee. I think that, and I said, I'm going to talk to people on the, if it doesn't get out of Judiciary Committee, it's not going to go anywhere, okay, because that's the committee of jurisdiction. So I said, what I'm going to do is I'm going to sit down with the chairman. I'm going to sit down with the other folks on the committee that are important for it to pass. I'm going to find out their concerns and why they oppose it, if they oppose it. They might back it, but I'm going to find out. Then I said, I'm going to sit down with you and go over these objections, if there are any, and I'm, certainly will be opinions, and I will help any way I can to see what the objections are, whether I think they are legitimate concerns or not, because I'll just leave it at that. That's where we are in the process. And because I'm on the committee, I can help with that. If I introduced a bill that ended up on someone else's committee, I would go to them and ask for the same kind of help. Because if you don't get your bill out of that committee, you might as well go fishing in terms of making a difference. And I know you are not interested in a public relations effort. You're interested in something passing. So I'm gonna have those conversations, and you've got my cell number. I think everybody on this panel does, and everybody in the audience as well. And I will give you an update after I talk to my colleagues on the Judiciary Committee, and we'll see where things stand.
I can't imagine why every mayor, every school board member, every quorum court member is not up there in
Some
New
of
York kicking those Wall Street protesters out and letting you know that these guys are their enemy.
Sure.
They're not collecting the tax that
Sure.
I'm having to collect.
And there's a lot of those. There are a lot of those up there. And you and I will sit down and I'll walk you through some of my colleagues' thoughts that I've already gotten on it. But I can assure you, I am engaged on this issue.
Well, then you'd change the name of it because it's not Main Street. Main Street
Well,
was
that's
in
the
trouble
Senate. Yeah.
way before
Yeah.
the tax thing got involved.
Yeah. And that's the Senate bill.
And I think they should collect the tax, because if you do it, again, if you do it in Arkansas, you're gonna make it a bigger mess. Each other person's gotta ship it here, send it here. You might get Amazon to put a store in here, and we'll ship out of Arkansas, and we'll charge your taxes here.
Mhm. Well, I can tell you, the Senate bill is the Main Street one for sure. Y'all's Main Street does pretty well, where you are.
Our Main Street was in trouble way before there was an
Yeah.
Amazon, okay? Because everybody's not that little squirrel thing. We're gonna talk about Main Street and say Main Street, but we're doing something way over here, because we're not talking about Main Street.
Well, luckily, a lot of the downtowns I like the fact that a lot of them are revitalized. And anyway, thank y'all for being here. I appreciate it. We've covered a whole lot of ground today. We've got a lot of different perspectives. I have seen definite themes emerge. The good news is they confirm a lot of what I already believed, and we learned some new stuff, which I'm gonna sit down with staff. The process here forward will be, I will sit down with staff. A lot of my DC staff are down here helping with this. We will get together. We will run through every panel. We will run through the discussion, and we will see how much of this can be implemented, and we will work with the appropriate people on doing that. The good news is I didn't hear anything today that is inconsistent with the stuff that I'm already doing, which is encouraging. And I think it's a lot of that's because I hear from a lot of y'all all the time. Thank y'all so much. Appreciate it.